Most people remember Enron. Everyone knows about Theranos. But there is one massive corporate collapse that has almost completely vanished from public memory, and its story is far more jaw-dropping than most realize. This is the shocking rise and fall of Adelphia Communications, a company that once controlled millions of people's cable television and internet across an entire nation, only to implode spectacularly due to one family's greed and deception. The rise of a cable empire in 1952, a Greek immigrant named John Rigas had a vision. Starting with just $300, he purchased a small cable franchise in a tiny Pennsylvania town called Coudersport and began selling cable subscriptions door to door. What started as a small operation quickly transformed into something extraordinary. Throughout the 1980s and 1990s, Adelphia Communications grew at an incredible pace, aggressively acquiring cable systems across 30 states. By the early 2000s, Adelphia had become the fifth largest cable provider in the entire United States, serving over 5.6 million customers. The company expanded beyond basic cable into high-speed internet and digital telephone services, positioning itself as a true telecommunications powerhouse. John Rigas became a household name in cable television circles. He was honored with degrees from multiple universities and was inducted into the Cable Television Hall of Fame. The company's name itself came from the Greek word for brothers, reflecting Rigas' belief in family values and loyalty. He even purchased the Buffalo Sabres professional hockey team for his son, Timothy, cementing the Rigas family's status as legitimate titans of American business. On the surface, everything looked legitimate. The numbers looked impressive, the growth seemed unstoppable, and investors couldn't get enough of Adelphia stock. But beneath this polished exterior lurked a criminal conspiracy of breathtaking proportions that would eventually unravel one of the most trusted cable companies in America. The unraveling of a dynasty for decades, the Rigas family maintained iron-fisted control over every aspect of Adelphia. John Rigas served as CEO, his son Timothy became chief financial officer, another son Michael ran operations, and James served as executive vice president of strategic operations. Nobody questioned them. The family's domination was so complete that internal oversight virtually disappeared. The cracks began to show in March 2002, when a financial analyst at Merrill Lynch raised a simple but devastating question during an earnings call. He asked how the Rigas family could afford to buy back over $1 billion of company stock. Timothy Rigas, serving as CFO, had no satisfactory answer. The question triggered a chain of events that would expose the most disturbing corporate scandal of its era. Just days later, on March 27, 2002, Adelphia shocked investors by revealing something that sent shockwaves through Wall Street. The company admitted it had hidden $2.3 billion in undisclosed debt. This wasn't a mere accounting error. It was an elaborate, multi-year scheme orchestrated by the Rigas family themselves. The family had created a complex network of shell companies and off-balance sheet partnerships that allowed them to borrow billions of dollars while keeping those debts hidden from shareholders and regulators. To be clear, the Rigases knew exactly what they were doing. They had deliberately used accounting tricks and financial structures that were intentionally designed to deceive. The debt wasn't really the company's responsibility legally speaking, but Adelphia had secretly guaranteed all of it anyway, meaning shareholders were exposed to massive liabilities they knew nothing about. But the off-balance sheet debt was only half the story. Federal investigators uncovered that the Rigas family had been systematically looting the company for years. Between 1999 and 2002, they siphoned off $2.3 billion in company funds for personal use. John Rigas ordered expensive Christmas trees to be flown to New York for his daughter, costing $6,000 per delivery. The company purchased 17 personal automobiles for family use. Most shocking of all, the Rigases used corporate funds to buy 3,600 acres of timberland for $26 million, purely to preserve the view outside John Rigas' Pennsylvania home. They also used company money to pay family debts, finance a private golf course, purchase over $770 million in Adelphia stock for themselves, and buy luxury vacation properties and Manhattan apartments. This wasn't accounting fraud in the abstract. This was a family treating a multi-billion-dollar company like a personal piggy bank while lying to millions of investors about its financial health. The collapse and consequences. Deloitte & Touche, Adelphia's auditor for 20 years, had just completed what they called their best audit ever. But within days of the March 27 disclosure, the firm completely reversed course and refused to sign the company's federal filings. Stock prices collapsed by 30% in a single trading day. The Securities and Exchange Commission launched an immediate investigation. Federal prosecutors moved quickly, By mid-2002, John Rigas and his sons Timothy, Michael, and James were arrested and charged with conspiracy, bank fraud, securities fraud, and wire fraud. The case went to trial and the evidence was overwhelming. In 2004, John Rigas and his son Timothy were convicted on multiple counts. In June 2005, John received a sentence of 15 years in federal prison, while Timothy received 20 years. Michael eventually accepted a plea deal. These were among the harshest sentences handed down for any corporate crime since the Enron collapse rocked the market. John Rigas, who had built an empire from nothing with $300 and Greek immigrant determination, would spend his final years behind bars. In 2006, Adelphia's assets were sold off to Comcast and Time Warner Cable in a complex multi-billion-dollar transaction that essentially dismantled the company entirely. The total damage was staggering. Investors lost over $60 billion, employees lost their jobs, an entire company disappeared from existence. The town of Coudersport, Pennsylvania, which had depended on Adelphia for 50 years as its economic lifeblood, was left devastated. The Rigas family's palatial corporate headquarters, valued at $30 million, sold at bankruptcy auction for just $3.4 million. Yet despite the magnitude of this collapse, Adelphia rarely appears in lists of America's worst corporate scandals. While Enron and Theranos became cultural touchstones, household names that everyone recognizes, Adelphia faded into obscurity. Perhaps it's because the company operated in an unglamorous industry that most people took for granted. Perhaps it's because the fraud was old-fashioned looting rather than cutting-edge deception. Or perhaps we simply forgot because there were so many corporate scandals in that era that no single one could hold our attention for long. But Adelphia's collapse taught us something crucial about corporate governance. It exposed how completely a family business can decay when there is no independent oversight, when personal relationships trump fiduciary duty, and when a company's board of directors becomes nothing more than a rubber stamp for executive decisions. The scandal directly contributed to the passage of the Sarbanes-Oxley Act in 2002, landmark legislation that strengthened accounting standards and corporate governance requirements across every publicly traded company in America. In that sense, the catastrophe of Adelphia helped protect future investors, but only because one family's decade-long crime spree was finally brought to light.